Every year, your government spends more money than it collects in taxes. Every year, somehow, that massive gap gets covered. So, where does that money actually come from? The answer isn't a conspiracy theory, it is a system. And once you understand how the gears of this machine mesh together, you will never look at a dollar bill the same way again. Most people imagine a government printing press, physically running non-stop around the clock. That is not how it works. Less than 10% of the money in circulation exists as physical paper cash or coins. The rest consists entirely of entries in a digital database. Here is the part that surprises people. Most new money isn't created by governments or treasuries at all. It is manufactured by private commercial banks, the exact same branches that hold your checking account. When a bank issues you a loan, it does not hand over physical money that someone else previously deposited into a vault. Instead, it performs a double-entry ledger expansion. It creates a brand new deposit out of absolute nothing and credits it straight to your checking account. That new deposit is brand new currency circulating in the economy. Multiply that single transaction across millions of loans every single day, and you start to see how the global money supply actually grows. This is the mechanical reality of fractional reserve banking. Banks are only required to hold a small fraction of their deposits in reserve, while the rest can be lent out and relent again and again. This multiplier effect means the digital numbers on your screen are backed by future debt rather than by tangible vaults of gold. It is the hidden engine behind modern economic growth. It is also the primary engine behind every catastrophic debt crisis in modern economic history. To understand who oversees this machine, we have to look past the current headlines and trace the historical blueprints of financial panics. Go back to 1907. A massive stock market panic swept through New York, and banks collapsed across the country. There was no central authority to step in and stop the systemic bleeding. The man who saved the entire financial system was a private banker named J.P. Morgan, who personally coordinated a massive bailout using private capital because no government mechanism existed to do it. That historical crisis permanently convinced lawmakers the United States desperately needed a structural lender of last resort. It wasn't the country's first attempt either. Earlier, central banks had been chartered, then dissolved, amid widespread public fear of concentrated power. 6 years later, in a secretive closed-door meeting on Jekyll Island, Georgia, a small group of elite Wall Street bankers and one United States Senator Nelson Aldrich drafted the blueprint for what would become the Federal Reserve. In 1913, Congress officially signed it into law. The Federal Reserve was designed with a strange, hybrid structure. It functions as a government institution with congressional oversight, but its regional member banks are technically owned by the private commercial banks they regulate. That dual structure has fueled a century of fierce debate about who the central bank actually answers to. Let us get specific. The Fed does not set interest rates by simple decree. It influences them by continuously buying and selling government bonds on the open market, a process called open market operations. When the Fed buys bonds from major Wall Street dealers, it pays for them by creating brand new reserves, electronically. Again, not by printing physical paper cash. Those reserves flow straight into the banking system, making it cheaper for banks to issue credit, which pushes interest rates down. When the Fed sells bonds, or lets them mature, it pulls reserves cleanly out of the system, credit gets tighter, and rates rise. This is the ultimate economic lever behind almost every headline you see about inflation, mortgage rates, or deep recession fears. It isn't magic, and it isn't a shadowy cabal pulling strings behind a curtain. It is a small group of appointed individuals at scheduled meetings, adjusting the actual price of money for the entire economy. Now, connect the dots. Governments consistently run deep structural deficits. To cover them, the Treasury issues government bonds. Someone has to buy those bonds, and often it is the central bank itself, especially during severe market crises. This creates a self-reinforcing economic loop. The government spends more than it earns. It borrows the difference by issuing debt. The central bank buys a portion of that debt by creating newly typed digital money. That money enters the economy, and if it enters faster than the economy produces real goods, consumer prices rise. That is inflation, in its simplest form. This isn't a fringe theory, it is mainstream monetary economics. The disagreement among analysts isn't over whether this process happens, it is over how much of it is healthy and how much becomes dangerous. There are two honest, data-driven ways to view this system. The mainstream view says central banking is a vital, stabilizing force for modern civilization. Before the Federal Reserve existed, the U.S. economy suffered a major banking panic roughly once every decade. Since its creation, widespread panics have become far less frequent, even though standard recessions still occur. In this view, controlled money creation is simply the necessary cost of a modern, functioning economy. The critical view says this system permanently concentrates immense power. A small group of appointed officials, who are not directly elected by the public, make massive decisions that affect the value of every paycheck, every savings account, and every retirement fund on the planet. This unique dynamic means entities closest to the money printer can deploy capital before prices rise, while ordinary savers absorb the full burden of currency dilution. Critics argue that money creation acts as a hidden tax, one that slowly erodes the purchasing power of savers, while heavily benefiting the elite institutions who borrow and invest that new capital early. Neither view is a conspiracy theory. They are two completely legitimate interpretations of the exact same set of historical facts. And the absolute truth probably sits somewhere between them. Here is why this isn't just trivia. If you keep your hard-earned savings entirely in cash while the money supply grows faster than the economy, your purchasing power quietly shrinks, even if the number in your account never changes. That is why understanding monetary policy isn't an abstract academic exercise. It shapes whether renting or buying real estate makes sense, whether cash or physical assets protect you better, and why interest rate announcements move markets you might not think you are exposed to. The people who understand this system position themselves ahead of it. The people who don't find out about it the hard way, one inflation report at a time. So, who controls the money? Not a single dictator, not a secret society, a deeply layered, systemic machine. Commercial banks creating money through consumer lending, a central bank steering the underlying cost of that money, and a government that structurally depends on both to fund itself. Understanding that system isn't about fear. It is about seeing clearly enough to make better decisions than everyone still asking, in confusion, where the money went. If you want deep, data-driven insights into how business, value investing, and macroeconomics actually operate, subscribe to this channel right now. Turn on notifications and share this analysis with someone who wants to understand the real systems behind wealth creation. I will see you in the next breakdown.